Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. What is going to happen to commodities and our stocks when the Fed cuts interest rates? The Federal Reserve has their meeting on September 18th, and they have forecast that they are going to cut either 25 or 50 basis points on September 18th, this coming Wednesday. What's going to happen to our stocks and what's going to happen to commodities when they do so? I pulled up the Fed funds rate and commodities and some stocks we're in and looked back over history at past Fed cutting cycles. On some of them, I was able to pull up back to 1989 and then 2000, 2007, and 2019 and looked at those rate cutting cycles and what happened to commodities and stocks that were in during those cycles and afterwards, and plotted them on the charts with percentage moves so that we could all see what past has happened. Caveat here, I'm not looking into any macro. This is all on the charts. I mean, I suppose other than when they stop cutting rates, they oftentimes introduce quantitative easing, which is essentially making more dollars. So of course the price has to go up because there's more dollars in existence. But I'm basically looking back at what's happened over history and trying to predict the future. Alrighty, so let's go to the charts. Starting out as always with the S&P 500. So we have, this one's kind of exciting, go back to 1989 and that rate cutting cycle. So this purple or pink line right here is the Fed funds rate. You can see the corresponding interest rate back here. We can see in the early 80s, it was all the way up around 18 or 19. And then, down here, it's down around 3. Just line it up with the one to the left here. And on the right is the price of the stock or commodity that we're looking at. So when the Fed cut rates here in 1989, the S&P 500 from the start of the rate cutting cycle to the end of it down here. So as this goes down, the yield, the interest rate is going down from start to finish. The S&P 500 made 39%. Interesting. Now here in 2000, when they cut interest rates, they went all the way up here from 6.5 and they went all the way down to basically 1. The S&P 500 lost 31%. Over here in 2007, the S&P 500 lost 41% in the rate cutting cycle. But look at what's happening after that when they're done cutting rates. Had some massive moves in the stock market. Here in 2019, now the way to read these is the yellow is the initial stages of the cut, the green is the middle stages of the cut, and the blue is the end from start to finish. How you did. So start to finish, you lost 17% in the S&P 500, but the initial phase of it had a 13% runoff, a 35% crash, and then it recovered. But look at what happened when they paused and went to free money down here. The S&P 500 went all the way from 2,200 up to almost 5. So it more than doubled. All right, now the dollar here going back, in 1989 cutting cycle, the DXY, now remember this is in comparison to other fiat currencies, 6 of them in various weightings, most of it being the euro and then the Japanese yen. But the dollar in relation to those other currencies lost 7% in the 89 cuts, lost 20% in the .com cuts, broke even, although very volatile during that time. Went way down, then way back up. You were even from start to finish if you held throughout. And then here in 2019, it gained 3%, although volatile. Now gold, this one's interesting. Gold in the 89 rate cuts lost 15%. This is spot gold. Gained 30% in 2000, gained 23% in 2007, and gained 16% in 2019. But look at what happens when free money comes in. You just have some massive moves here. From 2008 to 2011, you had 175% move, which is, I think, why a lot of us are in this trade. Right now, let's go to the gold stocks, Huey. Okay, so we'll go back here. We have history back to 1996. So we'll start with the 2000 rate cuts. The Huey from start to finish gained 300%. Now, if you go right here where they stopped cutting rates and they just paused from here to here, that little interim period there of about a year, you had another 71% move before you finally had a correction and down. All right. Now, the next rate cutting cycle, right here in 2007, initially it gained 58% from the start of the cycle to the top, then from the top down to the correction, minus 70%. From start to finish, you lost 35%. But after that, when they went to free money down here, you made over 330% if you bought the bottom and sold the top. Okay? Now right here in 2019, you have from the start of the cuts, now look, gold is leading it here. The gold stocks are leading it. And then you go from here, right around there, up to the top, you made 35%, 44% correction from there. And then you ended from start to finish up 4%. But after that, free money and boom, off to the races, 160%. Okay, seeing a pattern? GDX, not a whole lot of history on this. This is a new ETF, but in the great financial crisis, initial run up from when they start cutting rates down to here, initial run up 48%, a 70% sell off, and ended 39% below from where they started. So what I'm getting at here is I think there's going to be kind of a sweet spot where we can take some profits and then back up the truck, right? And we'll look over here at the 2019 rate cutting cycle when they went from 2.5 to 0. And we have an initial 25% bump, a 45% drawdown, ending even in the GDX. Now let's look at Agnico Eagle, one of the biggest gold miners on the planet. And we look at 1989, there is an initial run up of 51% and then a drawdown of 67, and you ended the cycle, the rate cutting cycle, 48% below from where you started. But look at this, free money and bam, just shot right up. Once the Fed has done their worst and they've paused and stopped, over 300% move. Okay, so I think there might be a little window here to time these things. We'll see. This one, 2000, from the start of the cutting cycle up to the top, 119%. And interim here, you had a lot of volatility, a lot of chopping, right? Back and forth and back and forth. This is probably people selling their gold and getting tech stocks and doing it the opposite of what they should. And, you know, drawdowns here of 45, 50%, run-ups of 50 to 65%, but from start to finish, from the start of the cut to the end of the cut, up 240%. And then for 2007, initial run-up, 130%, drawdown, 74%, ended the cycle down 21, right? Over here, 2019, initial run-up, 25%, drawdown, 50, ended 14% down. All right. So I really think there's some trading opportunities here. I like it a lot. I'm looking forward to this. This is going to be a lot of fun. Silver now, we'll bring this back, get some history on it. So for 1989 rate cuts, silver, the spot price itself, lost 34%. Then the beginning of the rate cut cycle, it lost 15. Then it gained 27 from the bottom to the top. For the duration of the cycle, you lost 2%. For this one, the initial rate cutting cycle, you made 62%. Then you lost 60 from the top to the bottom. You ended the cycle down 23%. This next one, for 2019, the initial run-up was 32%. The drawdown was 40. You ended the cycle down 3%. Now, silver stocks, if there's a better one here, let me know. Put it in the notes below because this doesn't have a whole lot of history. So I just went for the 2019, but initial run-up at 28%, a 50% drawdown, ending that cycle at 10%. But look at this. If you could catch those COVID lows and run it up to the highs, you made a 225%. Pretty incredible. Copper. Paging Dr. Copper. Okay, so we're going to look back over here. 1989 rate cutting cycle. Copper, spot price of copper lost 23%. In 2000, the spot price of copper lost 10% for the duration of the cycle. In 2007, copper lost 58% of its spot price, but had a massive recovery after that. When they went to free money, look at this move here, all the way down from $1.25 up to $4.60, 267%. And then in 2019, you had a loss of 19%, but after that, just another massive move. So I think some of the massive moves that we're waiting for in some of these commodities are probably going to happen once they're done cutting, depending on how quick they do it. Once they pause from cutting, I think that's when a lot of these are going to take some massive moves. But it looks like initially into the rate cuts, you got to kind of wait for the recession to really hit in. And I think a reason a lot of these stocks are selling off here, like this COVID crash, liquidity crisis, I guess macro, why they're selling off is if you lose your job, you're not worried about holding shares of Agnico Eagle. You're worried about paying the mortgage and putting food on the table. So you sell it. And although gold during this time did well and performed, these mining companies are the first to go. All right, now uranium. This chart only goes back to 2007, so we captured the 2007 GFC. Spot price lost 68%. In 2019, you basically broke even. It just kind of broke even for that cycle, not up or not down, at least not within a few percent. Now oil, okay, this one's interesting. Going back to 89 here, the initial in oil is a sell-off, minus 20% with a 100% blow-off here, 103% in the middle of the cycle, then a massive sell down. You ended the cycle down 5% in crude oil. Here's another example of that, down 48% in the dot-com bubble for the initial phases, then up 120% from there, ended the cycle down 10%. And here's kind of the opposite, actually, is up from the start of the cutting cycle, up 110%, down 75%, ended the cycle down 41%. And then in 2019, I didn't even really bother plotting the 11% move up from when they started here because nobody cares about that because it lost 63 by the time we were done. And then we just had that massive sell-off where oil went negative and it was the trade of my life. But look at this, free money right here. Oil had a massive run and just really, really played out. Now here on XLE, and make sure I didn't mention it earlier, but when you're looking these up, I know you guys are using TradingView, and when you look at these ones, especially like XLE that has a lot of dividends, hit this little ADJ down there, and that will adjust for dividends and change the chart. I already put in the values for what it was considering for the dividends, because these pay dividends every 3 months. And so you want to account for that like it's rolling it back into the stock. Anyhow, so for the 2000 dot-com bubble, initially oil stocks lost 35%, then gained 30 if you caught the bottom and sold the top. But for the duration of the cycle, you lost 18%. Here in this one, up 32% initially, down 58% from top to bottom in the interim, and then lost 35% in oil stocks for the duration of that. But look at that, free money, and it just takes off like a rocket from the bottom to the top here, 170 something percent. Okay, then over here in 2019, initially a sell-off during these rate cuts, you lost 64%, ended the cycle at down 49%, but again, free money comes in there and it just skyrockets to the top, almost 300% gains in that period. Not quite that from when they're only when they're paused. From when they're paused, it's basically, what would that be, right around there, 162% only. And then natural gas, bring back up the history of natural gas here. And don't quite capture the 1989 one, because it only goes back here to 1990, but I probably could have done it anyways. Anyway, so here for natural gas in the 2000s, So when they start cutting rates right here, you have a quick blip up. And I mean, this is only 5 or 6 weeks long, up 103%. And then from there, from the top to the bottom, down 80%. And then you end the cycle up 7%. This one in 2007, up 104% from the start of the cuts, down 58% in the interim, end the cycle down 15%. And then in 2019, initial run up of 22%, 44% drawdown, you end the cycle down 32. So this one, TLT, this is basically the trader's way to play the 20-year bond, right? And the way you think of this is as yields go down, the price of the bond goes up. And as yields go up, the price of the bonds go down. So we can see that, you know, they're inversely correlated. And so bonds you would expect do very well. And that's exactly what we found. From start to finish, from the start of the cutting cycle to the end of the cutting cycle, you made 29%. If you were a fantastic trader and caught the bottom to the top, or the start to the top, you made 44. That was in 2007. And this one in 2019, from start to finish, you made 26%. If you were a fantastic trader, you made 35. So in conclusion, I think that two things stand out for me for this. And that is that for the duration of the cycle, spot gold did well, and bonds did well. I also looked up VGLT and VGIT, which are intermediate and long-term government bonds that Vanguard kind of has like a trader's way for it that you can do in your 401k or whatever. And those did well as well. So bonds and gold did well. Gold did well 3 out of 4 times. Bonds did well every time, except when the bond vigilante showed up in the past, which is one of my main concerns on that. I think that nobody's talking about it, and we could have bond traders that instead of buying this thing and running up the price and the yield down, they might not just show up. And so what has to happen is if they're not buying it at 4.5%, then the price goes to 5. It's like an auction, you know, it literally is an auction. And then if it doesn't go to that, it goes 5.5. So meanwhile, your TLT is just going in the toilet. That's a caveat with that one. Another thing to take away, the S&P 500 3 out of 4 times went down. 1 time it went up. But one thing that I think is a real takeaway from this is these gold stocks. Look at GDX, initial run up, bam, then a huge drawdown, right? Initial run up, 25%, drawdown 45. Agnico Eagle, right? Initial run up, boom, 130%, down 74, 25% up, 50% down. 119% up, then just Charlie Brown pattern, but you end quite a ways up over 200%. Then this one up 51%, down 67, ending the cycle lower. So I think with these, we're going to want to find some sweet spots here. And I don't think it's now, but I think it's coming soon when we're going to want to trim these positions and take a cash position so we don't have to take this 50% haircut or 70% haircut. You know, when people are losing their jobs, they don't care about their stocks of Agnico Eagle, right? Same goes for silver. You know, you have a run up and then a sell off, right, for these silver stocks. But once they've done their worst and they have stopped cutting interest rates and they basically pause, I think that's the time and that's the signal to pile back in. And I am really, really, really looking forward to it. If you guys want to try out this software here, TradingView, I've done a video of how I set up my software, and you can just follow along and click as well with these. I love this software. I wouldn't be able to find any of this stuff if it wasn't for it. There's a link in the pinned comment below. And let me know what you guys think. Plot these things up here yourself and tell me what you see. Maybe pull up some commodities that I just didn't pull up, maybe like nickel or cobalt or whatever else you want, or maybe specific stocks like Exxon. But I would love to get your guys' opinion and see if you see the same thing that I do. And the way I calculated this here was I basically zoomed in on the weekly chart and I found the last point right here and go right down there, go to the weekly close, and then use this measuring tool and measure over to the point to where they're done the cutting cycle right there. and then you can get your percentages so that they they correspond here. So 9.5, I rounded up to 10. It's not exact, but you guys get the idea. When you're dealing in 225% ranges, you can be off by 1% or 2. All righty. Well, I hope you guys got something out of that. Please let me know what you think in the comments below, and try out the software. If you don't like it, it was free for 30 days. So check it out. All right. You guys have a great rest of the day, and be sure to support the show. Share this with anyone that you think needs to hear it. Probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.